All right. Well, Matt Orton is with us, Chief Market Strategist at Raymond James Investment. Matt, good to have you with us here as always on CNBC-TV18. Good morning. I thought the data last night from the US was pretty strong, but was it not strong enough for markets? Because yields came off sharply, or is it something else which was, the driver there?
Yeah, good morning, Prashant. Always good to see you. And I would almost flip that. The data was too strong, I think, for the market because it seems like the U.S. market and global markets in general are trading on this theme of good news is bad news. The stronger the data seems to come in, the more the market realizes that higher for longer really means higher for longer. We've talked about that really throughout this entire year, that the Fed is very serious. They're dogmatic about reaching their 2% inflation target. So when you get good news, that's great from an economic perspective, but it means that there's going to continue to be pressure that rates are going to continue to move higher, especially at the back end of the curve as the market normalizes. And so I've been meeting with clients over the past 2 weeks, and I can just sense the frustration and uncertainty that's out there. But what I remind them is the playbook that we've been recommending, the playbook that we've been talking about, Prashant, on the show, is leaning into quality. So owning companies that not only have stronger balance sheets that can weather a higher rate environment, but that are generating good free cash flow. They have a good free cash flow yield. They don't just have earnings and profitability, but they have earnings growth. And those are the companies that have outperformed. Quality has meaningfully outperformed the broader market over the past couple of months. And I think that's going to continue to matter going forward, no matter what region of the world you're in. So I would lean into quality and lean into micro drivers to help offset some of that macro uncertainty.
Matt, hi, good morning. We have seen quite a sell-off here in India as well. It started with mid-caps and small caps and spread to large caps. How would you approach this market? Would you buy? Would you wait for things to settle globally? What's the sense?
Good morning, Surabhi. And, I'm optimistic on India. India is my preferred region within the emerging markets. And the sell-off has been extremely swift. It's been a little bit surprising just given where the fundamentals are relative to the rest of the world. And I always say I'd rather be a little bit late and right rather than early and wrong. And so I do agree that we're likely, hopefully going to see some sort of bounce in the near term, but I want to see confirmation. I would like to see follow through that the bounce is going to be sustainable. And then I think the downdraft that we've had has created good opportunities because earnings, especially in some higher quality parts of the market, are still doing well. So I still think it makes sense to lean into some of the auto companies because you've seen some strength and relative outperformance in that part of the market. Similarly, I think within banks, bank earnings have actually been pretty good, but that's an area that's a little bit more questionable. I'd wait longer before going into. But you can also play defense in the food products part of the market too. There's some really high quality companies there, like Tata Food Products, consumer products. That's a company that continues to see good free cash flow generation, so that leans into that quality element, and you're able to play defensive growth. So I'd be looking to use that downside opportunistically. So get your shopping list ready and wait to get a little bit of confirmation from the market first.
Hi, Matt. Good morning. For us, the problem is the two pillars of the markets. That's tech and banks. Well, they have not really performed. Tech, maybe rightly so after the kind of run-up that we had, results didn't really match. But for us, the banking names, so they're important because they have a large weightage in the index itself. From the banking names, anything you liked, in terms of that shopping list, what's on your radar?
Yeah, Nigel, I think within the banks, it has been tough lately, but I think a bank like ECC, it makes a ton of sense. I mean, that's an area where you're able to get mid-double-digit ROE growth. You're able to get benefits from net interest margin expansion and a really, really solid balance sheet. So I think that's an area of strength. It's also a larger weight within the overall index. So if we can get the legs there, I think that's a bank that I would want to lean into and leverage some of this uncertainty to maybe build more of a position in.
All right. Matt, one would have thought, just sort of going back to the U.S. market, one would have thought that, the wicks, right, would jump substantially with these declines that we've seen. But I noticed earlier that it's not. I mean, it's still under, the highs that we made earlier, which was about 23 or so. Would you read anything into it? Would you, is it a non-confirmation data point, or you'd ignore it?
I never ignore it. I think the market, and this goes all the way back to October of last year, the market kept expecting some sort of capitulatory level of the VIX. The VIX has to reach 30, the VIX has to reach 40 in order for the market to turn, and it didn't happen then, and I don't think it needs to happen now for the market to move. I actually take solace in the fact that the VIX is still at the same level as it was earlier in the week, towards the end of last week, because what that says to me is there isn't as much of a demand for downside protection in the market, because the VIX at the end of the day is looking at the price of optionality. So if real money, if a lot of the hedgers in the market are already hedged, that to me is encouraging, and that means that when we do see some stability, you're going to see more buying.
Or maybe they're not adequately hedged, which you could read it both ways in case. And in that case, the outcome was different. But always good speaking with you, Matt. It's a pleasure having you with us here, and hope to speak with you soon again. Thanks indeed for joining us here on CNBC TV 18.